Welcome to another episode of Tax Law Guy. Welcome today, and today we are going to be talking about the difference between a tax lien and a tax levy. And you've probably heard those terms before. They both start with owing the IRS back tax, and then of course the dreaded tax lien and the dreaded tax levy will likely come up and come into play. And so today, if you're wondering, well, what's the difference between a tax lien and a tax levy, we're going to address that in today's episode of Tax Law Guy. So let's go ahead and get right into it. All right, so a tax lien. A tax lien gets filed against you, and you get the certified letter in the mail, and it says a notice of a federal tax lien, and that is the tax lien that's been filed against you. First of all, the address that the lien is mailed to is irrelevant for purposes of what property the lien is on. That's just the last known mailing address that the IRS has for you. So many times folks will get the tax lien and think that it only applies to that particular parcel or property. It does not. It actually applies to anything owned by the taxpayer, whether a current right of ownership or a future right of ownership. So that may include property, real estate. We typically think of our house, right? That's the primary asset that the tax lien is going to secure. It also includes any other assets that you may own, vehicles, boats, bank accounts. It will also cover any kind of business interest that you have. Technically, the tax lien is going to cover any kind of investment interest you have as well, such as stocks and bonds. So that tax lien is very broad. It generally is going to cover any asset that you own. And the tax lien in our country, a tax lien from the federal government, is filed with a recorder. So at your county recorder's office, the IRS is going to send the tax lien, and that's where it's going to be recorded at. That way, if you do try to sell a house, for example, that the tax lien is going to come up during the title search, and it's going to prevent you from selling that asset. And so that's what a tax lien is. A tax lien is going to secure your property for purposes of the IRS and their ability to collect against it. So a tax lien, first of all, is not going to show up on your credit report. We are asked that all the time, whether a tax lien is going to hurt your credit. And in terms of your Equifax or Experian or TransUnion credit reports, that tax lien is not going to show up there. Okay, so you don't have to worry about that. There was a Supreme Court case a long time ago that dealt with that matter, and since then the three bureaus have opted to not report tax liens, federal tax liens, on the credit report. So it's not going to show up on your credit. It is still public record. So second issue here is it is a public record. So if folks search for your name in the county where you reside, they are going to find that record. Again, that public record is what prevents you from selling your house if there is a tax lien. And so that is going to be present. A third point here I want to discuss is that tax lien is likely not going to be an issue for other small assets. So you go to sell your car, for example. Technically, it does cover the car. It is an asset. But generally speaking, when you sell a vehicle, they're not running a title search to see if there's a tax lien. So that's typically not going to be an issue. But technically, it does cover any kind of vehicle or boat or anything like that. And so, nonetheless, if a tax lien has been filed against you, again, we're talking about what the difference between a tax lien and a tax levy is. If a tax lien has been filed against you by the IRS for back tax, then it does secure all property that you have. So what do you do about that? Obviously, you probably don't want the public record out there. Maybe you have a house and you're getting ready to sell it and you want to deal with that. There are options on how to deal with the tax lien. So if you are going to sell your house, for example, you may want to consider a lien discharge. a lien discharge. And in that scenario, let's say your mortgage on your house that you're going to sell is pretty much the amount that you're going to get from the house. In that kind of scenario, you're not really getting any cash out at closing. You're just going to pay off the mortgage. So in that scenario, the IRS will allow you to remove the tax lien, discharge the tax lien on the house to allow you to sell it. And again, the tax lien is discharged only for that particular asset that is covered under the discharge. Maybe you want to get a new loan. You have an existing mortgage on your house and you want to refinance. Hey, these rates right now, crazy low rates, right? So you want to take advantage of those. So if you are going to refinance, the IRS may allow you to do a lien subordination where you get the refinance. As long as you're not getting cash out from that, the IRS will generally allow you to subordinate the lien. That way the bank will be fine with you getting a new mortgage, a refinance on your existing property. And there's other ways you can remove a tax lien as well. There's a special provision if you get on a payment plan for your back tax. Once you are within 60 days, if you're able to pay the tax debt off, not 60 days, excuse me, within 60 months, once you're able to pay the tax debt off within 60 months, the IRS will allow you generally to remove the tax lien if your balance is less than $25,000. Now, important caveat here, this is only possible if you've never defaulted on a direct debit installment agreement before with the IRS. So very important to know if you've ever defaulted on one of those direct debit installment agreements. So those are some of the ways you can remove a tax lien. There's a couple other that work as well, such as the offer and compromise. If you do a tax settlement, once you have paid your tax settlement, within 30 days, they're going to remove that tax lien as well. So that's a tax lien. So what is a tax levy? Well, remember we said the tax lien, it secures the property, right? It prevents you from doing anything with property. That way the IRS has first dibs on it. That's the purpose of the tax lien, where the IRS says, hey, you owe back tax, and so we don't want you doing anything with this property. We want to be first in line for it. Well, the tax levy is the IRS actually taking the property. So that's what you would consider a seizure. We also see wage garnishments fall under that category as well. So a levy is the IRS actually taking action, taking some kind of property that you have. That could be money in your bank account. That could be your wages, where it's a continuous wage garnishment. They continuously take from your paycheck, for example. That could be that they're taking your vehicle. It could be real estate. It could be the boat. Any kind of seizure where the government is taking an asset that you own for purposes of paying your back tax is considered a tax levy. So how do you stop a tax levy? Well, there's several ways. If you're under a financial hardship, that's a quick way to get the IRS to stop any kind of garnishment or levy. If, for example, the taking the asset's going to prevent you from earning income, that's also a great way. Hey, if you lose your vehicle, which they don't generally take your primary vehicle, how are you going to get to work? And so that's a great argument to make as far as why the IRS should not seize that particular asset. Hey, if you got a notice of a levy or notice of intent to levy, that's the IRS waving the red flag. They are waving the red flag saying, hey, we are getting serious about this. So if you get any kind of notice where they are telling you that they intend to levy, you need to take action. There are plenty of things that you can do. You can file what's called a collection due process hearing. Or if they've already initiated a levy, maybe you woke up and lo and behold, your bank account's been wiped out. They took all the money in there. You have very little time to get it back, but you'll need to file a collection appeal through the collection appeal program. and that's called a CAP, a C-A-P request. And under a CAP, if they've taken money out of your bank account, the bank's going to actually hold it for 21 days. So you have to move very fast to be able to get those funds back. So there are plenty of ways to get your money back or to deal with a potential levy. One of the best ways that you can deal with a levy is by dealing with the back tax through some kind of resolution. That could be a financial hardship where you don't have the ability to pay. The IRS will stop the levies, recognizing that you are under a financial hardship. That could be an offer in compromise where you do a settlement to deal with the back tax. Hey, did you know once an offer in compromise is filed and acknowledged by the IRS, they can no longer levy you, so you're not subject to the levy. And the other option would be an installment agreement. Setting up an installment agreement with the IRS will stop the levy threats as well. So that's the primary difference between a lien and a levy. The lien secures the asset. The levy takes the asset. So if you have any questions at all about a tax lien notice or a levy notice that you received, please reach out to us. We would love to be able to answer those questions for you. We're available by either dropping a comment below in the comment section, or if you want to, reach out to us by email or phone. Again, that information is also below. So thanks for watching another episode of Tax Law Guy, talking about liens and levies, and we'll see you next time.